As investment products, the mutual funds are often compared with what is called the PMS. PMS stands for Portfolio Management Services. Now, many people often kind of are confused which one is a better offer, and we thought it's a good idea to bring clarity to that. Now, mutual funds as a concept is what we call a pooled investment. Small retail investors pool in sums of money and then it's given to a fund manager, and the fund manager manages it as a pooled concept. So a single portfolio across all the investors, and thereby generating returns at large, which then gets divided among all the investors in proportion to their investment. It's a very simple concept, very powerful concept. Mutual funds are for the common man. For as small a number as 500 rupees or 1000 rupees, one can start getting into an investment plan in mutual funds. It's as simple as that. Second, it's a concept that does not involve taxation at an individual level. At a scheme level, only when you invest money and you pull out money is there are taxation implications. What the fund manager does within that fund has no tax implications. So to that extent, it's a great product for investors who are creating long-term wealth because there is no taxation in that. Third, the cost of operation is extremely small, given that a large pool of assets is managed by one fund manager or a small team. The costs are extremely low. In fact, if one were to go to index funds, the costs are even lesser. So it's a very, very thrifty product which gives you great returns on a very, very small kind of cost, so to say. So mutual funds have great advantages when it comes to investing and creating long-term wealth. But what are portfolio management schemes then? And that's the question most people have. Now, PMS, as they are called in short form, are products which are more specialized. These are meant for high net worth individuals. The minimum threshold as per SEBI for portfolio management schemes is 50 lakhs. So which means that it's not really a retail product for everybody. What are the advantages of portfolio management scheme? First up, one is the portfolio manager is essentially your specific portfolio manager. So he creates portfolio specific to your need. So he really kind of understands what you need. So there's a bottom-up stock picking approach that he does. And he is not guided by any philosophy of either the benchmark or the index like Sensex or Nifty and so on. He will go with his conviction of which is the best stock to invest so that he can generate the highest return for you. So it's really very, very selective, very, very specific, very customized work that a PMS portfolio manager will do on your behalf. Second, it is not a pooled concept. You have a specific demat account into which the stocks that are meant for you is bought and kept. So to that extent, it's a very individualistic kind of an exercise. Although the firm that is offering the PMS may have a model portfolio, but ever so often everybody's portfolio will not be identical. There will be small changes in between there. So to that extent, there is a difference. Third, the purpose of PMS is to be far more aggressive. As compared to a mutual fund, the PMS comes with the idea that they need to generate quicker, more opportunistic returns. So in that sense, the fund manager is oriented to take a much higher risk than what you would find in a regular conventional mutual funds. So these, my friends, are the basic differences in the advantages of each of these products. Some of the disadvantages or cons of investing in both these asset classes are as follows. As far as mutual funds are concerned, essentially mutual funds tend to kind of follow a certain benchmark. So if you're trying to invest in a large cap mutual fund, it will perform in line with or somewhere close to the large cap index. So it's a very index driven, it's a very methodical performance. Second, the fund manager's mandate in a mutual fund is to stay completely invested. So even at the risk of a big global meltdown, the fund manager will not stay in cash in a mutual fund because the mandate is to stay invested in funds. So they will largely sit with funds. Maybe they will do a 5%, 7% or even 10% cash, but that's it. 90% will continue to stay invested in funds. Third is that mutual funds tend to kind of take a very commoditized approach. Between fund A, fund B and fund C, there may not be much of a difference. Between all of them, they follow a very standardized package. Securities Exchange Board of India has defined different categories of funds. So you will need to operate a fund within that category, within those criteria. So if you're a large cap fund, for example, all the fund houses need to invest only in the top 100 companies which are listed. Therefore, the differentiation becomes very limited and becomes very commoditized. So these are all the negatives of mutual funds. Now let's understand what are the negatives of or the cons of portfolio management schemes. Now portfolio management schemes are for the elite. They are not for everybody. So unless you have 50 lakhs in your kitty, sorry, it's not for you. Second, it's a high risk product. Do not get into a PMS believing it's safe. Far from it. The fund manager is incentivized in terms of a profit share because he's trying to generate a much higher return even within the equity market. So it is not for faint-hearted people. It is for people who really have the ability to take big risks. Third, unlike in a mutual fund where one can redeem a part of the investment, in a PMS, unless your value is significantly more than the 50 lakhs, you cannot draw money out of it in a smaller quantum. So essentially you may have to close the scheme, or the amount that you will be able to draw is only what you have over that 50 lakhs. So to that extent, it's not a very flexible product. That way there are exit loads and for 18 months and so on and so forth. So it is a little bit more complex product for a slightly longer period of time. So investors who are oriented towards that, who feel they need to do that, are the people. So in our belief, everybody must invest in mutual funds, but a few people who have a lot of money in mutual funds already and yet have another 50 lakhs should go into PMS if they have the appetite to take higher risks. Now that being said, some of the case history of people who invested in PMSs are as follows. First up, somebody who's got a lot of ESOPs in a company. So in a specific company, somebody has large holdings. They are people who can use PMSs as a route to diversify some of their holdings. And in diversifying, they don't need to pay cash. They can give stocks and create another portfolio. So that's one way of creating a more diversified portfolio. Second, somebody has a large portfolio that they've inherited. They don't know anything about stock market, but they've inherited a large portfolio of stocks. Makes sense to go to a professional who can manage it really well for you rather than trying your luck at it. It's a lot of money. Third, you want to invest in direct stocks but don't know how to go about it. Always a good choice to go to a professional. So that's where PMS players come in, portfolio management schemes. And all these three cases demand that somebody look at PMSs much more closely.